Good evening, family, and welcome to another installment of your Wealthy Wallet Wall Street course. Man, I hope y'all had a great week. As again, man, we do our things on Saturdays because while everybody's partying and trying to do their thing, we learning how to increase our wealth. We learning how to align our pockets. We learning how to build generational wealth so our family don't have to struggle. That's why we here sitting on a Saturday learning how to do these things. And last week we talked about how to read a financial statement. Now we're going to talk about how to analyze that same exact statement. Now that we know how to read it and or understand it in some way, now it's time that we learn how to analyze it, learn how to figure out what is this data telling us? What is this saying to us? I mean, now that we know how to read it, and if you don't know how to read it, I want you to watch the video over and over and over again till you completely understand how to read a financial statement, because a financial statement is very imperative not only to read another company's business, but also when you want to start your own business, because a financial statement is basically your report card. It's your report card in life. It's your report card if you want to become an entrepreneur. It's your report card in building your own business. Learning how to read a financial statement is imperative, period. No, nothing else said. You got to learn how to read a financial statement. If you don't, come holler at your boy, right? And let's learn how to read a financial statement. Now, let's learn how to analyze it. I want to talk to you about how to analyze a financial statement today because it's an instrument that we must learn how to use in order to properly evaluate companies, right? In analyzing a financial statement, there has to be a standard of comparisons. So when conducting a financial analysis, there should be a benchmark for comparisons. A current benchmark is an intra-company comparison which uses the prior year or years of of a same company as a benchmark. So as a benchmark, I know that in 2017 we were bringing in 50 million in revenue. So now let's take a look at 2018. Then 2018 we brought in 55,000 in revenue, right? So and then 2020 we brought in 60 million dollars in revenue. So we see these benchmarks as our own personal self as a company. We see where we are and where we strive to go, right? You In our own life we should have personal benchmarks, for growing, for becoming better, increasing our knowledge. Every quarter you should be reevaluating yourself, figuring out, okay, this is how much I've learned in the last 3 months. This is how much I increase in health. This is how much I increase in knowledge. This is how much I increase in business knowledge. What did you do over the last 3 months? Because we need to evaluate ourselves based upon every quarter, right? Because that's how you begin to set benchmarks. Okay, I know that I didn't do anything here, but I know that the next 3 months I have to dramatically increase myself in these areas, and these areas. I got to make something happen. There's got to be a standard of comparisons. There's got to be a benchmark for your own self. And then after there's a personal benchmark, you have to do benchmark in comparisons that is in comparisons to other competition. How's the other people in the same field doing? Are they doing as good as me? Am I doing better or am I doing worse than they are? See, these are benchmarks. These are basically starting lines or lines that tell you where you probably should be. If you and the company have the same product and the company down the street is making twice the money you are, you must find out what's going on. How am I going wrong? If the company down the street has double the amount of customers you have, then you have to figure out, what am I doing wrong? Why can't I get the same amount of customers? Is their product better than mine? I mean, is their marketing thing better than mine? How's it working? You need to take a look at the competition, because this helps you to set your own type of benchmarks. If everybody's outselling you and you're selling less than everyone else, why are you coming last? You got to find these things out, right? And then the final benchmark in industry standards is average. Often industry benchmarks can be obtained from financial websites, right? So long story short is, okay, if everybody's making about $20 million in their business, everybody's doing $30 million. Am I doing $1 million in my business? And somebody in the same field as me are doing, 1.2, another person's doing 980,000. We all doing about an average of what is expected in this industry. But if I'm way below average of what I'm doing in my industry, then I need to figure out, what am I doing wrong? If I'm above average, then I need to continue to study myself and continue to reinvent, right? Because I always want to continue to grow. And other companies are going to start looking at you and trying to figure out how you're doing it way better than they're doing it, right? We got to have benchmarks in life, period. We got to have a standard of comparison. So when we're looking at companies, we look at where they were before, where they were 5 years ago, where they were 3 years ago, where they were 2 years ago. This is how you begin to analyze a financial statement. And then you look at the competition. Are they kind of in line with the competition? If I have, three different software companies and we all making about the same money because we all do the same thing, or if I'm one of those companies, I'm super far behind the other two companies that do a similar thing to me, then what's really going on? Do I got bad management? What's happening? And then the bench, am I average of all my big brothers or all the people in my industry around me? Well, I mean, what's really going on? This is what financial statements help you to be able to see. So with that being said, understanding the nature of financial analysis is very, very useful in investing. Understanding a company's income statement, their financial positions, their statement of cash flow, and a statement of changes in equity with current and prior year data for comparative purposes are a starting point for anyone looking to do an analysis into any company or into anything, even in your own personal life, right? But there are three ways to analyze a financial statement. There's a horizontal analysis, which is the comparisons of a company's financial results across time. Some of y'all like, bro, I don't know nothing you just said. Don't worry about it. I'm gonna break it down for you. And then our vertical analysis, which is a comparison of financial balances to a base account from the same company in or compare against another company in the same industry. Bro, like I said, I don't know what you're talking about. Don't worry about it. I'm gonna break it down for you. You're gonna completely understand everything. You're gonna completely, when finish watching these videos, you're gonna completely understand how to break down a financial statement. And we're gonna do a ratio analysis, which compares the different balances from financial statements. Ratios are grouped together to assess a company's profitability, ability to pay debt, and survive in the long run, right? So we're going to learn all these things. We're going to learn if the company is able to survive in the long run. We're going to learn how they look in comparisons to their self over a period of time. We're going to start and we're going to look how they look in comparisons to other companies and the competition that's around them. We're going to learn how to properly assess a company value because we need to know a company's value, right? Because at the end of the day, you're investing in them because, you are investing in them because you see an opportunity to make money. So if the company's not going to make money, then why should you invest? You want a return on your income, right? ROI, you want a return on income. This is why you invest in the stocks. This is why you invest into the market. You want to see your income grow, right? And as a part owner, you have to figure out if this company's going to be making money or not. And if they are not going to be making money, then you need to find somewhere else to dump your money. But in order to properly evaluate if they are going to make money in the future, then you have to know how to effectively read or analyze a financial statement. And last week we talked about how to read a financial statement. And this week, again, we're going over how to analyze it. And so since we're going over how to analyze a financial statement, let's start with a horizontal analysis, right? So what is a horizontal analysis? A horizontal analysis is the comparisons of historical financial information over various reporting periods. It helps determine a company's growth and financial position versus competitors or themselves. The horizontal analysis technique uses a base year and a comparison year to determine a company's growth, right? I'm talking about that it helps us to form trend analysis by taking at least 2 or more years of data and analyzing it. And I'm going to show you how we're going to do that over a cross period of time. And by being able to recognize trends, right? Trend analysis can be used to build prediction models to forecast financial performance. That's what trends help us to do. Because if we understand past behavior, then we can kind of predict future behavior because future behavior will always be predicated upon past behavior, right? So we need to see, is the company trending in an up trajectory or are they trending in a down trajectory and why, right? Trend analysis can also be used to identify problem areas by looking for sudden abnormal changes in accounts. And we're going to talk about a lot about abnormal changes in accounts, right? Yahoo. So what we do, I want you first to go to Google, right? Go to Google. Scoot me over real quick. Scoot me down a little bit. And then go to Google Drive. Want to go to new document. Want to go to Google Sheets. That way you get an spreadsheet. And since we learned last week how to read uh, Apple's financial statement, let's continue to use Apple so that we can go over Apple's financial statement. So let's do Apple financial analysis. So let's name this Apple's financial analysis, right? And then we're going to go to yahoo.com. Click the finance tab. It's going to take us to Yahoo Finance. Type the ticker symbol, which is Apple, right? Which we learned what a ticker symbol was in previous classes. If not, then go back and view the classes. And remember, Yahoo Finance is free, unless you want to upgrade to the premium, which gives you a little bit more data. All right, so we go down. Okay, now we got the financial statement up, right? All right, so now that we got the financial statement up, let's learn how to properly do a financial analysis. All right, so first you want to start out with total revenue. Total revenue, right? Start out with total revenues, but that over a little bit more. Let's make this whole line. Let's make this whole line a little bit bold because we want to be able to read these things. Bold. Stretch it out a little bit more. All right, so we're going to start with total revenue. Then we want cost. Then we want to start out with cost of sales. And then we're going to start out with profit. All right, we're going to do a horizontal analysis on these things. And if, again, you don't know what these are, go back to last week's class and then go over with you the total revenue, the cost of sales, and the profit of a financial statement. All right, so let's go back to Apple. And then remember, we're going to take 2019 is going to be our base year. 2020 is also going to be a year that we're going to be analyzing. So we're going to take the total revenue, right? Total revenue for 2020. I'll copy that. I'll copy the total revenue for 2020. So put 2020 right here and 2019 right here, right? All right, so let's do the base. All right, and then we're going to take and copy 2019's revenue. And these revenues are in millions, remember? So that means Apple made 274 billion, but let's get they made 274 billion in 2020 and 260 billion in 2019, right? All right, so now we got to go get the cost of sales. Let's go back. Cost of sales. Remember, cost of sales is what it cost them to make the product, what it cost them to generate a product to sell, right? We went over that in last week's statement. So what did it cost them to generate this money? What did it cost them to make $260 billion? It cost them 161 billion to make 260 billion, because you do not get something for nothing. It's always a generation of income is always going to cost you something. Always remember that it's always going to cost you something. You don't get nothing for anything. I mean, you don't get something for anything. So let's make this a little bigger. So we'll make it 12. Also do these next two rows. So also make it bold and 12. All right. On the next row, you're going to put change. And then the last row, we're going to put ratio. All right. All right. So on this change row, hold on. Before we go to the change row, let's get the profit. Remember the net profit after taxes, after sales of good, after SGA. You know, we got an SGA, meaning operating expenses, right? Well, we paid employees, research and development, pre to after taxes and everything. We want the profit. All right. And the profit's always going to be found in the net shareholders common stock, which is actually the bottom line. That's their comprehensive income. It's the bottom line number, right? So we're going to take that and post that. I don't know why I didn't format. 12. All right. Ooh, we put it in the wrong place. That's why. Copy. Put it in the wrong place, folks. It's supposed to go down here. 2020. All right, same thing. Let's go get 2019 real quick. Copy and get 2019. Put 2019 in there. Why is that silly? We want to highlight that. All right. Now we got to figure out the change. Let's figure out the change. Now that we have our total revenue, which is the total money generated from them selling all their products, right? And then we have the cost of sales. What did it cost to make those products that they generated $274 million on? And we have the net profit after everything's paid. After the $274 billion in revenue, they only profited $57 billion in revenue. After the cost of sales, after paying everyone, after research and development, paying taxes, paying all the bills basically, right? It left them with a net profit of $57 billion. All right, so let's figure out what happened. So on the E section, we want to take these two and subtract one another. So you're going to hit the equal sign, right? And then right here is column C, right? So row C. So we want to take row C and minus row C and column 5. So row C, column 5, and minus by row D, right? Because we want to subtract 260 billion from 270. We want to subtract 274 billion from 260 billion. 260 billion from 274 billion, right? So then we're going to get D5. And that spits out answers for us. And guess what? Google says, do you want to automatically fill, right? And let's say it doesn't fill, right? Let's say it doesn't automatically fill, right? You can go here and drag it down like that, and it automatically fills. It automatically calculates the rest of these numbers for you automatically. All right. So in order to get our ratio of these numbers, we want to do the same thing. We want to put an equal sign, and we want to do the change minus by the base year. The change divided by the base year, right? So we're going to do E5 divided by D5. And what do we get? I'm going to autofill these numbers, right? Let's autofill these numbers. People looking at like, what's these numbers right here, though? What is these numbers right here, though? All right, but we want to change these numbers to a percentage. So you click on percentage. Boom. I'll change it to a percentage. You want to keep it the same. You want to change this to a percentage. So let's look at this for a second. So Apple made 5% more on their money in 2020 than they did in 2019. Their cost, right, was 4.8% of last year. So they increased their cost by 4%, right, from 2019 to 2020. But they made 5% more. They generated 5% more in revenue in 2020. So that's about a 1% difference, a little under a 1% difference, right? So they increased their cost by 1%, but they also made 1% more in revenue, right? Which led them to increase their profit by 3%, right? And you're doing good in the business if you can increase your profit by 3 to 4 to 5% each year in the business, right? Because over a 10-year period, you're going to be setting real solid, right? So they generated 5% more in revenue in 2020 than they did in 2019, right? And they generated another cost. The cost went up by 4% in 2020 versus 2019, but they were able to make 3% more on their money, 3% more profit on their revenue that they increased. So what that also tells me, in 2019, since their revenue went up 5% and we were in a pandemic, what's that tell you? that their products are in demand. Come on, holla at your boy now. It tells you that their products in demand. So you analyzing this, they didn't decrease, their revenue did not decrease, their revenue did not go down, but instead their revenue went up. In a pandemic, they made $14 billion more in revenue. They generated $14 billion more in revenue in a pandemic, right? So they were able to make $274 billion still in the pandemic. So it shows us that Apple products are in demand. Apple's an amazing company, especially if you're able to generate $14 billion more where every other company was losing money hand over fist, right? But Apple made out pretty good. If you're able to increase your revenue by 5% in a down economy, an economy that's a global pandemic going on, right? But you're able to increase your revenue. So what does that show? What does it show investors? What does it show to investors, you as a company? It shows, hey, Apple knows how to pivot. They know how to adopt. They know how to change. They know how to do things to keep them on a upward trajectory, right? That's what this shows you. So when you analyzing this statement, like, okay, this is a trend. They're rising in numbers. Their trend shows you that their money is increasing even in a pandemic. Imagine if there was not a pandemic, what they would have done in 2020 if they were able to succeed in doing these type of numbers in a pandemic. Imagine if it had not been a pandemic. But let's say, imagine if these numbers were a little different, right? Imagine it says negative 5%, right? Then that might have been okay, right? Why that might have been okay? Because again, we were in a pandemic. So what if they would have lost 5%? What if they wouldn't have not increased their revenue by 5%? Instead, their revenue decreased by 5%. What if that was a negative? This shows us things that happen. But what if it wasn't a pandemic and they lost money, right? We want to see what's going on. Did the cost of sales increase, right? Because if their revenue went down, but their cost of sales increased, I mean, what's going on? Sorry, y'all. I mean, I want to know what happened. Why did their revenue go down? Did they sell as products? Were there a shortage somewhere? I mean, what happened to where their revenue fell, right? Did they run out of supplies to continue to sell? I mean, did they run out of products or being able to supply the market in a proper way? Why did their revenue go down? Did they decrease their advertising? People are losing demand, right? What happened? Why did their revenue increase, right? Decrease if it wasn't a pandemic. I want to know why, right? But pandemic is kind of explanatory, right? But then what if their cost of sales went way up, right? What if this cost of sales went up 10%, but they only generated 5% more on increasing their cost of sales? We're gonna have to take a look. Hey, the products that y'all spent more in developing and making, it's not working out, right? Because you generated less money than you actually put out there, right? To even make the product. So we have to take a look at our product. Hey, was this a right fit? Was this the right type of product? Because if we're going to spend, $10 billion more in increasing our product or adding new products to the line, but those products are not selling because we're not generating the revenue, right? Then we want to start taking a look. Hey, man, we might have to discontinue some stuff, right? In a business, you have to find out what works fast and what doesn't and get rid of it, right? Because if something doesn't work, there's no use of you continuing to try to use it and continue to try to go on with it. You figure out if it works. If it don't work, you throw it away. This is how business works. And this is how life works. If it works, it works. If it don't work, get rid of it. It's called adapt and adjust. Adapt and adjust. I mean, adjust and adapt. I'm sorry. Adjust and then adapt, right? And then you have to figure out what does work for you. So let's say if it was down, if the cost of sales went up 10%, right? And let's say if their profits went down, right? We want to see what if they didn't make 3% more, which is $2 billion more from the previous year. They made $2 billion more from the previous year in profit. What if that showed they lost $2 billion, right? It'd be kind of okay because again, folks, we're in a pandemic. But what if we lose that type of money and we're not in a pandemic? So what then does it show you? That shows you that, hold on. Let's figure out why we lost $2 billion because
if the cost of sales only went up 4% from last year, but we were able to make almost 1% more in revenue, and profits are down when we increased our revenue, hold on. So it's not the cost of sales then, because we made more money by producing more products or adding new lineups to our products, right? So it's not that. And if it's not that, then I have to figure out, why do we lose money instead of make money when we made more revenue? Because the more money coming in, the more money you should make. So if you got more money coming in and costs to not go up substantially, you know, then why did I lose money? So then we got to start taking a look at the SGA, right? Selling, general management, operating expenses. We got to take a look at the operating expenses. Again, go back to last week if you don't understand what I'm talking about, because this all comes together. You got to know how to analyze this financial statement. In order to properly know how to analyze a financial statement, you must know how to read it, right? So if you go back, and we helped us understand that either operating costs went up, something happened. Why did they make less profit on their money? So operating costs must went up. Let's see. I mean, did we give out too many bonuses? Did we do too much? I mean, what happened? Did we spend too much money in advertising that did not work? I mean, what happened? We don't know what happened. Why did they lose revenue? I mean, why did they lose profit when they increased their revenue? This helps you to properly analyze a company. You want to know these things as an owner, right? Like, even if you create your own business, you want to understand that I brought in more money, but I took in less money. So that makes you scratch your head. I brought in more money, but I took in less money. You got to know those things as a business owner. Even if you're starting your own business, you want to know, why did I bring in more money and take in less money? Let's see where those costs are coming from, right? Let's see what's helping to decrease my profit. And this is why you want to do a horizontal analysis on each company, because it shows you these trends. It shows you how they're doing over a period of time or across time, right? And then you take a similar competitor, Apple's, and you do the same thing right next to, like I just showed you. And if they show you that the same competitor as Apple actually lost money while Apple increased in value, it shows you that Apple products are probably more in demand than Android products or Samsung products, right? Or Google phones, right? So if we take the same thing, it helps us to understand these things. And we take a competitor, just other than comparing Apple to itself, right? This helps give us an even better analysis, because if we know we have a company similar to Apple, but yet they lost money and Apple made money, it shows us Apple's above normal, right? So we expect above normal profit for Apple to continue to go on an upwards trajectory. They're the first $1 trillion company. They're the first $2 trillion company, and they are going to be the first $3 trillion company. Mark my words. Because Apple seem to know what they're doing. They got their heads on straight. Tim Cook is running a tight ship, and you want to see that in each company. In each company that you invest in, you want to know the management. You want to know how they run and operate the day-to-day business. Why? Because again, you're a part owner, and being a part owner, you should know how people are running your company, right? You're fractional. The moment you invest into a company, you have fractional ownership. So you want to know how the management's doing as far as running the company, how the CFO's doing, how the CEO's doing, right? How the employees doing, the upper executive management doing, right? Because at the end of the day, they're going to be the ones to help generate profit. And the profit is what you and I put into our wallets. Because the more profit they make, the more it's going to cause the stock to go up, because people's future perception of Apple is going to be optimistic. So then, therefore, the stock is going to go up, and it costs more money to go in your pocket. So of course, we want to know how these people doing. That's why I follow Tim Cook. I follow these people on Twitter. Every company I invest in, I follow them. Why? Because I want to understand the leadership. Because if I understand the leadership and I love the leadership, then hey, and the leadership is doing a great job, then I love them and I understand they're putting more money in my pocket. So that's how you do the total. This is how you do a horizontal analysis. Well, let's go down to a vertical analysis real quick. Let's type it in. So let's call this. This was a horizontal analysis. was a horizontal analysis, right? Horizontal analysis. Now let's do vertical analysis. All right, so we start with the vertical analysis. Same thing, but guess what? This time, folks, we can just copy and paste these, right? Copy this. Let's just paste it right down here. Boom. We only want the the data from 2020 and 2019. We don't want the change order ratio, right? So again, after we take that, I want you to select this. You're gonna see the little hand, and you move the data right over because we're gonna need the space, right? And then for a vertical analysis, right? What is a vertical analysis? Let's go look. Let's go look. Okay, vertical analysis is a technique in which the relationship between items in the same financial statement is identified by expressing all amounts as a percentage of the total amount. This method compares different items to a single item in the same accounting period. Vertical analysis will always compare companies' account balance within a 1 year period, right? It makes it easier to understand the correlation between single items on a balance sheet and the bottom line expressed in a percentage. And with this, it can become more of a potent tool when used in conjunction with horizontal analysis, which considers the finances of a certain period of time. Donnie, what are you talking about? I don't know none of this crazy stuff. This is why we're going to break it down in layman's terms, right? So let's go back to where we was. All right. So before we begin breaking down vertical analysis, let's go ahead and do the math real quick. Let's do some math. I know a lot of people like I wasn't good in school. I was not good at math in school, but don't worry, you don't have to be a scholar. You just need to know basic math to be able to create Excel sheets like this. But this definitely will help you out big. All right. So let's go. So now we do the total revenue. So we want to divide revenue by revenue first. So remember, revenues in row C, right? Row C, row C, column 14. So row C, column 14 divided by C 14. And we should get, did it wrong. Equal sign C 14 divided by C 14. And remember, horizontal analysis goes across, vertical analysis up and down, right? Horizontal, across, vertical, up or down. This is why you call it horizontal analysis, because it tracks things across time. This tracks things up and down. All right, so but we want to change this one to percentage real quick. Boom. All this, we need all of it to be this bold. And the next one, we're in row C, right? I want to minus it, so we want to take row C 15 divided by the revenue, right? So we want to take this and divide it by the revenue. So which was C 14. And I forgot to put the equals. Boom. Then we want to change this to percent. And the same thing. You take, what was it, C16. First got to do the equal C16, right? Row C, column 16. And we want to divide that by C14, which is the revenue, right? And then we want to go ahead and turn it into percentage. Let's go ahead and make these bold real quick. 12, bold, boom. All right. And we want to take the same formula, right? Copy. And you want to put it over here. Same formula, put it over here, right? All right, so what are we looking at, Donnie? Please tell me what we're looking at. All right, let's take a look at this. Okay. In 2019, right? Let's go back. This is 2020, and 2019. All right. So in 2020, right, it tells us that the revenue was 20, I mean, that the profit was 20% of the revenue, right? But in 2019, the profit was 21% of the revenue. So, boom, okay, okay. In 2020, the costs were 61% of the revenue. And the cost in 2019 was 62% of the revenue. So it shows me that costs went down and profits went down a little bit, right? Costs went down and profits went down. So basically, when you look at 2019, they got to keep 21% of the money that they generated. But in 2020, they only got to keep 20% of the money they generated, which is they got to keep a little bit less money. But we see up here that they made, I mean, 2 billion more dollars than they did in 2019. But the cost of goods went up, and other things could have went up. Operating expenses might have went up. They may have outsourced a lot more things because of the pandemic that was going on. So they decreased. They got to keep a little bit less money than they're generated, right? But that's not that bad. I mean, a small change in percentage like that, that doesn't really throw up any red flags, right? So we understand that again, a vertical analysis helps you to understand that they got to keep almost 21% of the money they generated when they got to keep a little over 21% on the money they generated in 2019 versus 2020. It shows me that their costs went down, right? So they had to spend less money upon the revenue that they generated because the cost was 62% of the revenue. Now the cost is only 61% of the revenue that they generated, which costs went down, profits went down. So it shows me a little bit more expenses came from probably operating expenses. That's what that shows me because a little bit more. I know it didn't come from cost, or I know, then I know up here it shows me that they did not generate less revenue. So then I know that a little dip in the profit that they were able to take home comes from probably operating expenses. And of course, hey, I will increase my operating expenses for my people if they help me to generate $2 billion more in a pandemic, right? Of course, I'll throw out some bigger bonuses, right? Right? Because they helped me succeed in a pandemic. I didn't fall on my face. I didn't lose money. I made money in the pandemic. So a vertical analysis shows me this company paid a little bit more in operating expenses, which they probably paid to their employees. I don't know, but I know is that they decreased costs, right? Even though their costs went up 4.8% from last year, it lets me know that they decreased costs because they pay less costs to generate more revenue, right? Here they pay more costs to generate more revenue. But at the end of the day, I'm okay with this. This vertical analysis helps me to see that and helps me to see a trend, right? Their cost is going down. They made a little bit less money, but their cost is going down. It helps me to understand that they probably pay more in operating expenses, which I'll be okay with that, especially in the pandemic. But that helps me to understand that the money probably went toward operating expenses, and operating expenses might be toward paying their managers, executives for helping them to accomplish $2.1 billion in the pandemic, right? $2.1 billion in the pandemic, right? All right. And then so now that we understand these figures, and if you want to understand a little bit more, you can always holler at your boy, right? You can always DM me, and I will go over this even more with you. If you don't understand something, or watch this video over and over and over, and go and watch the other videos over and over and over until you properly get it, right? That leads us to the next thing. ROE. Let's go where we go to slide real quick. All right, profitability. Profitability accesses through the calculation and interpretation of ratios. Profitability is critical for a company's long-term survival, but the amount of total income tells us little about the efficiency and effectiveness of those profits, right? So in order to properly calculate a profit margin ratio, then a profit margin ratio, we have to understand what a profit margin ratio is, right? And that profit margin ratio compares net income to net sales and measures the ability of a company to generate profits from sales. A higher ratio indicates a greater ability to generate profits from sales, right? So this is teachers total comprehensive income, which is the bottom line income divided by net sales. But we're gonna do all that. We're gonna jump into all this. This is why I just want to throw it out there real quick. We're gonna jump into all this. So the return on equity compares profit average balance and shareholders' equity, showing how effectively a company uses the funds provided by the shareholders during the year to generate additional equity for its owners. Right. So on how we do this, how we figure out the return on equity, because we want to see if the company's actually generating money with the money that they were given. Right, from people like me and you. So we take the total comprehensive income, which again is the bottom line income divided by the average shareholder equity. And then a return on assets, right? The return on assets ratio compares income to average total assets, representing the ability to generate profits from its entire resource base, not just the resources provided by the owner. So, uh, and you know what? I meant to change this, break this down. But I'm sorry, folks. It says I meant to put assets right here, not equity. All right. That's me to do that. All right. Let's go back. Sorry about that. So return on assets, right? Total comprehensive income divided by the average total assets, and return on assets equal beginning assets plus ending assets divided by 2. But let's jump into this real quick. Let's go ahead and jump into it real quick. So we need to know first profit, right? Profit. Then we want to know open equity, close equity, open assets. We want to know close assets. Let's make that bold real quick. Look, what are you about to do, Donnie? I'm about to show you. This is all going to come together. I promise you. This is all going to come together for you. You're going to learn a lot. This is all going to come together. All right. So we want to know what first? We want to know. Let's put it right here. Let's do ROE and ROA. Let's do that real quick. ROE and ROA. Let's make it bold. Let's see. 14. ROE and ROA. Return on equity and return on assets. All right. So we got the profit. What was the profit in 2020? Copy. Boom. Profit. Boom. Right there. So we got the profit. Now let's go find what the open equity was. In order to find the open equity, we got to go to the balance sheet, and we learn what the balance sheet was, right? Shareholders equity, right? You see it, shareholders equity. You creep down the total equity gross minority interest, right? Meaning interest that does not have controlling power, right? The shareholders don't have controlling power. They have enough say so and their voice is heard, but they don't have a majority stake, which it has the controlling power. And again, go back to last week's class if you need to understand that. All right. So in order to get the open equity, we want the equity ending in 2019, because the stockholders equity ending in 2019 will be the opening equity of 2020. Right. So we go back, post open equity, right? And then let's get the close equity real quick. Let's the close equity, $65 billion. All right. Now it's asking for open assets. All right, open assets, right? Total assets, right? You go to open assets. Let's look. Not current assets, all assets. So open assets, remember, the closing assets of 2019 will be the opening assets of 2020. Then we post that, and then okay. Then we go to the close assets. All right, now we got it all, folks. So let's figure this out real quick. Boom. So we got that. Let's stretch it out a little bit more. So what it is that we want to do, got the profit, right? Copy. Put the profit right here, right? And we want to also, so now that we got the profit right here, this is how you get the return on equity. So we got the profit, you take the profit and, copy and paste and put it over here, right? And then it's the total net profit divided by average equity. So, all right. So now we got to get the average equity. We want to put the average equity right here, right? Before we do that. So you type in average, right? First you type equal, then you type average, and you want to get averager because we need the data set, right? And then you are able to select these two, and then it calculates the average for you, right? Bada bing, bada boom. Make that bold like the rest of them. Bada bing, bada boom. Calculate the numbers. Expand a little bit. Let's take away a couple zeros, too many zeros. Right. And the same thing with ROA. I'll take the profit, copy, boom. Then we want to take the average of the profit, so average of the assets, I mean. So we go do equal, average, so averages, the set numbers, and then we're able to select these two, and then hit enter. Automatically calculates it for you. You need to make it a little bit bigger. Number, let's get rid of a couple of zeros. All right, so then after you get that number, right? All right, so now that we got the numbers, let's go ahead and calculate the ROI, right? So you're gonna take H, so equals H 19, right? It's in row H, column 19, and you want to divide that by H 20, right? That gives us, we want to turn it into a percentage, 73%. I want to do the same, so copy, boom. So here's what we got. Let's highlight, let's make it nice and bold. All right, so folks, what does this tell you? Right? What does all this tell you? Let's highlight all this. Let's put this. What does this all tell you, right? Make this bold. What does this properly tells us? So it tells me the return on equity was 73%. 73%. So on the money that me as an owner and many other fractional owners gave to Apple, they were able to generate 73% more equity for us. This company is a monster. They was able to produce 73% more on the equity that they were given. So it shows you this company's ability to continue to thrive even in a pandemic, right? So they did, not only did they increase the money on their revenue and their sales, but they also increased the money that we gave them and made us more money. And what does it mean for me and you? More money into our pockets. That's what it means. So the money that we gave them as a shareholder, right? The money that we invested into the company, they were able to almost double that, right? Almost the money we gave them. So Apple has continued to do their thing, man. That's why my hat's off to them. And on assets, that means That means the money that they made on everything, their debt, their shareholders' equity, all the money they made using assets and debt together, they were able to increase. They were they made 17%. I mean, so not even just increased by 17%, but they made 17% with all their given assets on all their given assets. So not only is Apple doing good with shareholders' equity or shareholders' money or investors' money, but they're also making money on the assets that they hold. They generated 17% in income on the assets that they held over that period of time, right? So, man, this just shows you the Apple's generating money on their assets. It could be whether they're leasing out buildings or property or land or licensing things. But all I know is they made money on their assets and they made money on my money. So that shows me that Apple is completely killing the game. And so, like, why would I not jump into this company? Why would I not get into this company when they're just completely destroying the game? When they're completely killing the game, hand over fist. They made money in the pandemic. They making money on our money, and they're making money on the assets that they house or that they hold. Right? Apple's killing the game. So, folks, I hope you learned a lot. Please continue to read this video over and over and over. If you don't get something, listen to it over and over and over. Holler at your boy. All you got to do is DM me if you don't understand something. I'll break it down more for you. But definitely, this is Apple's killing the game. I mean, there's no other way I could say it. They're on top of it. Great company to invest and hold your money because saving money is for suckers. You're gonna keep your money in the bank. It's called invisible interest. Invisible interest is called inflation. Your dollar loses 2% every single year that your money's in a bank. So you need to put your money and so invest your money into a great company where you continue to make money each year. And Apple is one of those companies where you should. That's where I invest my money. I'm not giving any recommendation to jump into anything, but I'm just telling you, saving money is for suckers. I don't save money because I know there's always a hidden tax. Invisible tax is called inflation. You lose 2% on your money every single year. So while you're saving in the bank, that $1 became 98 cents. You know, so I mean 90. I mean became 98. No, yeah, 98 cents. So hey, folks, figure out a way to start making money, using your money, and not letting people abuse your money. Other than that, please, folks, do not forget to subscribe, follow, and like. Especially if this information is very valuable to you and you learned a lot, make sure you follow, subscribe, and like. Thank you again, and I'll see y'all next week as we go over the EPS and which is earnings per share and price to ratio and other beautiful things to become a better investor. Thank you again.